Greetings, and welcome to the All Facts Matter podcast, where we push back against corporate media propaganda with facts, evidence, and data. I'm Peter, the author of All Facts Matter. Let's begin. Yesterday, the Bureau of Economic Analysis released their first advanced estimate of the third quarter GDP for the U.S. economy. And Wall Street was somewhat less than impressed. The BEA announced that the real GDP, the real gross domestic product for the third quarter, grew at an annual rate of about 2.8%. Now, Wall Street had been expecting more or less a repeat, maybe a little bit of an improvement over the second quarter results. And second quarter GDP is reported to have grown at 3%, and Wall Street was expecting about 3.1. So they were a little disappointed that the numbers came in below that, and proceeded to reflect that in stock market performances, which closed down on the day, and interest rates, which rose a little bit. But overall, the reaction of the market was relatively minor. You didn't see a tremendous movement in the stock markets. It took all day for them to actually slip into the negative after the BEA numbers came out, and interest rates only rose about 10 basis points. So there wasn't a tremendous display of sentiment either way. Basically, Wall Street was, as I said, disappointed. Now, that's kind of that itself is disappointing to me, because when you look at the numbers, when you look underneath the headlines of the BEA's news release, we realize that there's actually some dynamics here that are quite alarming. Wall Street should have been far more concerned about the numbers than they were, and we should be far more concerned about the numbers than Wall Street has been. So one of the comforts that Wall Street was taking was that even though the growth wasn't where they wanted it to be, consumption expenditures were still strong. There had been some movement in government spending, and these things were pushing up economic growth, and so they were allowing themselves to be mollified, you could say, lulled into maybe a false sense of security about the state of the economy. But if we look at the change, if we focus in on the changes in these elements of GDP, the difference between how much change we saw in expenditures, in investment, in exports and imports, and in government spending, we begin to see something rather disconcerting. Growth in private domestic investment just all but disappeared. What happened to it? Where did it go? Yeah. Yes. In the first quarter, through the third quarter, we're seeing an increasing growth in personal consumption expenditure. We're seeing a similar increasing growth in government spending. The net of exports and imports is typically negative, but even that had although it had gotten worse in the second quarter, had improved again in the third quarter. But investment, which had improved from Q1 to Q2, dropped off the face of the earth. What happened to it? We need to look at that. We need to, this is something that should concern us, uh, because private domestic investment is really where the economy begins. This is where uh, purchases of equipment are being made. This is where buildings get erected. This is where the capital investments, that will fuel future business activity uh, originate. And so when suddenly growth in private domestic investment basically stops and goes from 80 billion 2017 dollars to almost none, we need to ask why. And when we look into it and see, well, what happened to that investment, the answer is it just kind of went away. Yeah. Investment in non-residential structures, which is basically your commercial real estate, uh, has in fact been basically disappearing all year long. It dropped off as effectively to zero growth in the second quarter, and was slipped into contraction in the third quarter. Uh, Real estate investment, residential real estate investment, your home building activities, um, again, went from some growth in the first quarter to contraction in the second quarter to more contraction in the third quarter. Yeah. Intellectual property, the various software programs that are used to power businesses, back office operations, factories, etc. Uh, Growth in the first quarter all but disappeared by the third quarter. Great significant reduction, just not happening. The growth really slows down. The only bright spot in all of this is that equipment purchases, which were very minimal in the first quarter, picked up in the second quarter and increased a little bit further in the third quarter. But that's the only aspect of investment that has been getting better all year. Growth in investment growth for every other category, non-residential structures, uh, intellectual property, and residential structures, has all been getting worse from Q1 through Q3. And this is a negative trend. This is a negative investment trend. This is a decline, not an investment yet, not overall, but it's a slowing down of investment. It's an increasing reluctance to be investing in things like commercial buildings, housing, intellectual property, and these are not good. These are not good indicators of what's likely to be coming ahead in the economy. You know, when people and businesses stop investing in these things, they're not expressing hope. They're not expecting optimism for the future. Yeah, and when we look at we don't get any balancing comfort when we look at the uh, government spending, because while government spending was part of what fueled the growth in gross domestic product that we did have, we see that the overwhelming portion of that growth is defense spending. You know, spending. Let's be blunt about it. Defense spending means spending on weapons of war. Uh, you know, you can, if you want to read commentary about the situation in Ukraine or what's happening in the Middle East into this defense spending, probably not. It's far off base with that. And how regardless of how you feel, one feels about those events. Yeah, this is not funding a military is not ever going to be as productive a deployment of capital as funding a business. That's the nature of war is inherently destruction, not creation. And so, if you want productive investment, military is only going to give you so much of that. So when we see government spending and government defense spending uh, powering economic growth, this is not a sign of a balanced economy. This is not a sign that we're maintaining an even keel on our economic outlook. And if we come back to the components of GDP, we can see that you see that uh, uh, the only two contributors really to economic growth in the third quarter were consumption, which we expect to see, and government spending, which, okay, yes, it's there. Yes, it's contributing to the economic growth in a technical sense, but uh, you, we would be much better off if the amounts being spent in government spending were showing up in domestic investment. If we have to see only two elements contributing to the growth of the economy, I would much rather see consumption and investment powering the economy, not consumption and government spending. Yeah, that would be nice. If we saw exports positive, meaning we're exporting more goods than we're importing, that would be great too. But what is really bad is this lack of domestic investment. This is government spending is not a substitute for this. And even though the BEA's reporting and a lot of the media reporting looks at it that way, and we'll say, well, okay, we had government spending increase, so the economy grew. Well, yeah, but we didn't have domestic investment, and that's not good. Yeah. Now, let's also take a look at the export-import equation. What we have to understand when we're looking at exports is that imports are counted as a reduction in GDP. Exports, of course, are an addition to GDP. And if you think about how exports and imports work, and just the basic transaction model, money flows into the economy when you export goods. Money flows out of the economy when you import goods. So this is how we have, it's that money flow that makes it makes the one an additive and the other a decrease. And we'd seen while the net of exports and imports was negative, meaning we imported more than we exported. It had this, that balance had improved in the third quarter, and the reason it improved, when we look at that, is we see that exports of goods have been doing better this year. We'd had a reduction in the amount of goods exported in the first quarter over the fourth quarter of last year. Second quarter, we had an improvement over the first quarter, and third quarter, we had a dramatic improvement over the second quarter. And so, just on the export, so we're seeing a very positive trend in export growth. uh, we're seeing not quite the same. We're seeing a kind of an indistinct trend with exports of services. They their growth slowed in of service exports slowed in the second quarter, and then picked up a little bit in the third quarter. But what kept the net of exports and imports negative was the fact that even as export growth was doing fairly well, import growth increased even more. So import growth had been increasing in the first quarter. It increased again in the second quarter, and it increased significantly by a significantly larger margin than export growth increased in the third quarter. And so this is how we get this into a. This is why that net of exports was negative. But we still want to take note of this positive trend, because this shows us where the opportunities lie in the economy, where there's why there's reason for hope in the economy, and also it begins to illustrate why the lack of investment is a warning signal. And the reason for that is that what we also see in the third quarter GDP results is we still have a significant demand for physical goods, both durable and non-durable kind, in the economy. That while there was some reduction in that demand in the first quarter, ever since there's been increasing growth. We're more interested in buying more stuff. We're buying more widgets, more gadgets, more doohickeys. We bought more in the second quarter, and we bought still more in the third quarter, both in both non-durable and durable categories. So across the board, we're seeing an increased interest in purchasing, in consuming, these physical goods, the physical stuff that people make. And this is a positive sign, because while we're importing the majority of these goods right now, which is why we see the import quantities outpace the export quantities, this is also, there is at least a potential that this is consumption that could be theoretically satisfied in many cases by domestic production. Even if it's being satisfied by imports now, in theory, you could the necessary productive plant, necessary factory, clothing manufacturer, whatever, could be brought into operation within the United States and satisfy that demand domestically. The question, of course, is whether that could be done in a fashion which is profitable, given, of course, the relative prices of imports, which is but that's very much a technical question, a business strategy question of how you make that happen. But it does show there is a market here that domestic production could satisfy, and coupled with an increase in exports means there is productive capacity. There's not only productive capacity in this country, but there's an interest in the outputs of productive capacity in this country, and this is noteworthy because this means that what we're seeing in the United States is the opposite of what we've been seeing. What I've been writing about is taking place in China. China is a good exemplar of the opposite of this, and also tells us why the opposite of this can be a real problem. China has an abundance of productive capacity, and when it comes to manufactured goods, it is an export nation far more than it is an import nation. But what it doesn't have is a lot of domestic consumption. And its economic challenge is it's trying to stimulate domestic consumption, but it simply doesn't have the capacity for absorbing manufactured output is simply not there in China. It's missing. And all of their stimulus measures are running up against this basic reality that the average Chinese consumer just doesn't have the money and the willingness to spend on goods. They've got the capacity, they've got the supply basically, but they don't have the demand. In the United States, we clearly have the demand, and that demand is in search of supply. Right now it's being serviced by imports, but it's still demand in search of supply. And this also feeds into an examination of where that demand comes from, or how that demand comes to be. That demand comes to be, of course, because people have money to spend. They have incomes that they have earned, and that money needs to go somewhere. In aggregate, that's called the personal income. But it's made up of a variety of the specific types of income. You have compensation of employees, your typical worker's paycheck. You have proprietor's income, which is people running their own businesses, your mom and pop shops, your sole proprietor type businesses. You have rental income. You have income receipts on various assets. These would be like your investment portfolios, 401k plans and the like. And then you have current transfer receipts. These are government payments, in essence. As we can see, there was a tremendous spike in government payments during the whole COVID pandemic panic nonsense and in the immediate aftermath, and then that finally settled down. But we already see, just looking at this, we see one reason to be concerned about this, because paychecks are good. This is people going to work. This is people with jobs. This is people showing up for work at a factory or at a shop or a restaurant or whatever, and doing productive labor. Proprietor income is self-employed people doing fundamentally the same thing. Showing up to do productive labor. Rental income, investment income. These are private assets being put to work. So these are not, passive income, but still, income from the private sector. This transfer receipts is the government handing people money. And while, while the investment income is kind of looks to be tilting down a little bit, we see the transfers are actually starting to increase here. They spiked hugely during COVID, but they're staying high. They're much higher than they were. The government is funding personal income to a much larger degree now than it was prior to COVID. And this is a disturbing trend because transfers are not paychecks. And if we look at the ratios of these, we begin to see we start to see more of how this is shifting. And we see that as a proportion of personal income, compensation of employees has dropped in recent years. Post-COVID, the workers' paychecks is a smaller proportion of personal income than it was. We see the same thing to a lesser degree with proprietors' income. People are making less money off of being self-employed. People are getting more money from the government, and we can see the magnitudes of these trends a little more clearly if we index them. readers of All Facts Matter will know that I'm a big fan of indexing. Is a great way to zoom in on the magnitudes of changes. To kind of get an insight into the trends that are actually taking place. And so when we look at the magnitude, when we index these and look at the index them to January of 2017, and look at the magnitude of these changes, we see, okay, this is just how much of an impact transfer payments, government payments had on personal income post COVID. I mean, it just the government just stomped on personal income. But prior to that, the various components of income were more or less stable. There was a little bit of fluctuation. Stock market did well, so personal income receipts went up. That's not surprising. Of course, since that was taking up a larger share of personal income, the other elements were coming down a little bit, but it was staying within the broad range. And in 2019, it was pretty much still about the same as where it was at the beginning of 2017. So throughout Trump's presidency, throughout the pre-COVID portion of Trump's presidency, the components of personal income were broadly stable. A little bit of fluctuation, but not a lot, and it was coming back to the same spot. Of course, COVID, we see the disruption. Everything gets shook up through COVID. But then, as things start to settle down, we see income on a decline. We see paychecks, compensation of employees on a decline. We see proprietors' income on a decline. Investment receipts on assets, investment income has been rising, then been tapering off lately. Rental income rose significantly. It's starting to taper off. Transfer receipts had fallen a little bit, are coming back up again as a proportion of personal income. But again, they're significantly above where they were. So what we've seen here during the Biden-Harris administration, and what the third quarter GDP results are showing, is a continuation of a trend where productive income has become less important. Passive income and government transfer payments has become more important in terms of people's personal income. This is not a healthy trend for an economy, because you need to have productive labor to have productive output. You need people working either as employees or self-employed to be generating productive economic output. You're not going to have that kind of productive economic output from rental properties or from investment portfolios. These are, of course, good ways to augment an income, but it's not the same as having, it's not the same as building something. In order for the productive aspects of an economy to be growing, people need to be building things. Anyone who remembers the 1992 presidential election and H. Ross Perot's third-party candidacy, his take on the economy, which he delivered in his trademark East Texas twang, which I can't possibly replicate, was, "We're not making enough things." And he had a point then, and he still has a point now. We're not making enough things, and we're deprioritizing the making of things based on what's happening with personal income. Where people are getting their money is less from productive labor and more from passive activities. Yeah. And again, where does this start? It starts with private investment. So when the investment drops off, when growth in private domestic investment just abruptly halts in a single quarter, this is something that people should take a look at. Like, okay, what's happening here? This is not good. Why is this happening? Why are we not investing more? Why are we not putting more money into into businesses, into commercial real estate, into housing, into making widgets and gadgets and doohickeys and all the stuff that goes into the building of the creation of physical wealth. Uh, that's what this is, and that's what abruptly halted in the third quarter. It didn't completely disappear, but there was no growth in it. Instead, we made more. We're making more. We're making more tanks. We're making more guns. We're making more defense hardware, but we're not making anything that's going to. We're not making the widgets and gadgets and doohickeys that are going to lead to the creation of actual physical wealth in this country. And when we look at the pattern of the breakdown of GDP throughout the course of the Biden-Harris administration, we see that at the beginning there was growth in private domestic investment, and then during the after about the first quarter of 2022, it really dropped off, and it we've not seen growth in domestic investment to match what was happening at the end of 2021. Obviously, with the residuals of the all the pandemic lockdowns, investment had been shuttered in a lot of ways, and this was still coming back online. But there was a recovery burst in late 2021, but it wasn't sustained past the first part of 2022, and investment contracted actually for a couple of quarters. We've had a little bit, then more contraction, but investment has been significantly weaker in the latter part of the Biden-Harris administration than initially. And when we look at the income shifts, this is where the investment started tapering off, and look what happens. We see that paychecks and proprietor income, productive employment, is becoming deprioritized as a source of personal income. Well, this is where you start to see the shift towards more passive income, which is ironic that for Kamala Harris on the campaign trail to be talking about investment, for President Biden to be talking about investing in America when there's been a decline in investment. There's been a decline in investment growth over the broader trajectory of the Biden-Harris administration. And that's what the numbers are showing. And to quote A. Truss Perot, once again, we're not making enough things. And it's hurting people's paychecks, which means it's hurting employment, which means it's hurting small businesses. And instead of that getting better in the third quarter, investment growth basically stopped. And it doesn't have to be that way, because during the Trump years, 2017, good growth in domestic investment. Hit a high water mark in 2018, and yes, it began to taper off. This was not good, but we had a much longer period of sustained growth in domestic investment, and only at the very end, at the very end of the pre-COVID years, do we see domestic investment actually start to contract. Of course, COVID shakes everything up. So that's why I stopped the chart here at the at the end of 2019, because 2020 is just it's a year that just doesn't compare to anything. There's just nothing to be gained by incorporating that. But this is why when we wonder why was income rising, were wages rising relative to inflation, why was the economy doing well? This is a major reason why the economy did well under Trump, is because businesses were investing. And that's what we didn't see in the third quarter. And that's a problem. Yeah, that's one of those things. That's one of those economic numbers that when you see it, you should be alarmed, not disappointed, worried, alarmed. You know, that's one of those numbers that when you see a drop off in investment like that, be afraid. That's a bad sign. Be alarmed. And unfortunately, Wall Street's not alarmed. They're not looking at that. Corporate media is not looking at that. The government is not looking at that. And that's a very bad sign. That's a warning sign that things are not things are not heading in a good direction in the U.S. economy, and the third quarter GDP numbers basically prove it. And that's all I have for this session of the All Facts Matter podcast. If you I hope you found this presentation informative and enlightening, and hopefully it increased people's understanding of economic events. Certainly, I hope it gave people something to think about. That's always my objective with these things, with my work here. If you like this presentation, please like it and please share it out to your friends, and encourage them to sign up for the All Facts Matter Substack. Please also consider making either a one-time donation or, if possible, becoming a paid subscriber to All Facts Matter. Your support is what keeps this work going, and I greatly appreciate everybody's support, especially the free subscribers. The people who take an interest in my work are the ones who definitely keep me going in this, and I appreciate everybody's support for the work that I do here. But that's what I have for today. Thank you for listening. Thank you for watching. And have a nice day.